Live from our studio in New York City, I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. We're an hour away from the close on Wall Street, and investors are looking to close out the year on a high note. The Dow heading for another record close, and the S&P 500 is just a few points away from reaching a new milestone. We're tracking the market action, the top movers of the day.
Plus, a look at internet and AI plays for your portfolio in 2024. Tech, we know among the biggest winners this year, and a top analyst bringing his ideas, and they might be flying under your radar.
Meanwhile, mortgage rates pulling back again last week, but the decline in rates still not doing much to boost sales. The latest pending home sales were flat in November. We'll break down what's happening in the housing market later this hour. Let's get you up to speed on the market action now, as we get into the final few days of the year, you could call it perhaps the melt up that we are seeing for the major averages here. We have for the last several years seen stocks rally for the Santa Claus period, as it's called, the last 5 days, 5 sessions of the year, the next couple of the new year. This time around, we've seen it as a pretty steady stream upward, right? With not many pauses, even though it's just a little bit day by day, and that means that we are getting closer and closer to a record for the S&P 500. Now, as we've talked about yesterday, the closing record high, 4796.56. So we're not there, but sort of like inching, maybe inevitably, inexorably in that direction. The S&P 500 is up for 5 straight sessions. And what we've seen on the Nasdaq side of things is the Nasdaq 100 is setting up for its best year going back to 1999, the Composite for its best year since 2003. So in other words, to sum all that up, closing strong.
Yeah, I mean, we are, as you noted, Joe, we're in the middle of the Santa Claus rally. At least some technicians I'm reading, when they look at the charts here, they don't see reason for alarm in the very near term, at least. Any pullbacks they think would be, mild. Investors probably, they think, just interested in kind of maintaining the status quo. As we wrap up, what you say has been a very strong year here, a strong run. That is, of course, you can chalk that up to the boom of interest in AI. That has helped lead the charge for the so-called Magnificent Seven. That's Amazon, Apple, Alphabet, Meta, and Tesla. But also the rally, it's not just the Magnificent Seven. As we've talked to different strategists, that has been rallying, right? We talked a lot about the small caps, the equal weighted indexes starting to participate here as well. And that, of course, if that continues, that's a bullish sign. Yeah,
that has been something that has been encouraging stuff and encouraging strategists. And by the way, it's also not just stocks, right? Some data out from Bespoke today shows that the 60-40 portfolio is back, baby.
60% stocks, 40% bonds.
Yeah, which is sort of the classic allocation here. And so Bespoke looked at the numbers and said, now we are very, very close to this combined portfolio seeing its best performance over the last 2 months, going back to at least 1990. So they're looking at the rolling 2-month performance of this 60-40 portfolio. That's what you're looking at here. So very, very close to the best that we have seen. And it is because stocks have been doing well, but even more importantly, it is because of the big turnaround that we have seen in bonds over the last couple of months with the buying happening in the bond market, pushing yields lower. And by the way, we talk all the time about treasuries, but it's not just happening in the treasury market, it's happening in the corporate market as well. So that's all of that contributing to that performance.
Yeah, it is true. We see the market, we do talk about how that kind of rally has been broadening, though there was some interesting stats from Bespoke as well, saying, relatively high number of stocks, they point out, with gains over 100%. There haven't been as many outperforming the SPX, Bespoke pointing out in a typical year, they say on average about 49% call it of the SPX members post larger gains than the index itself. This year, less than 30%.
Yeah, let's talk more about all of this and what it perhaps portends for 2024. For that, we turn to Sam Stovall, CFRA Research Chief Investment Strategist, a great guy with stats on the market as well. Sam, it is great to see you. I want to start where we were just talking about, what Josh was just talking about. That is this broadening of the rally that we have started to see. Do you think that continues? And does it indeed mean that more gains are coming here into 2024?
Hey, Julie and Josh. Good to talk to you two again. Yes, I think that 2024 is going to be a surprisingly good year. Historically, good years follow great years. We've actually seen an improvement in the average price change by 200 basis points, an improvement by 10 percentage points in terms of frequency of advance after a 20+% gain. So that's the first thought. Second thought is this is the election year. First term administrations, usually they're up about 15.5% on a total return basis, with every one of those years being positive. So again, another positive indication. I think we might, however, be getting a little bit overbought in terms of percent of sub-industries above their 50-day, stocks above their 50-day, the CNN greed fear factor being at extreme greed levels, et cetera. So I think maybe a post all-time high pause. But as Josh said, nothing really to fear because the next decline of 5% or more will probably come about 10% after a continued advance and would not likely lead into a new bear market.
So Sam, maybe some near-term overbought here, but looking ahead, some potential strong tailwinds. I am interested, Sam. After you've seen the rally like this, how does valuation look to you? Does that still look attractive even at these levels?
Well, at 20 times forward 12-month earnings for the S&P 500, it is higher than the long-term average, which is about 17. But I think because investors are anticipating an end to the rate tightening program, expecting to see the first cut, the street is looking for the first quarter. I think that the Fed's going to wait until the second quarter. But still, the market tends to advance about 14% in that 11-month period between the last rate hike and the first rate cut, lifting all boats, if you will, in terms of sizes, styles, sectors, and sub-industries.
Are there those that particularly stand out, though, as doing better in that kind of a scenario, Sam?
Yes, well, financials are one of the groups that tend to be outperformers in this Fed pause period. Real estate also does fairly well. And so I think also that taking a look at the groups that has done so well this year, they will likely carry over into 2024. History tells us that following a down year, you want to buy last year's losers because they're the ones that have the most to recover, and that's what we saw in 2023. But following an up year like 2023, you want to let your winners ride. So consumer discretionary, communication services, and tech, but also the honorable mention as found in industrials and financials.
So Sam, those are the sectors, as you said, let the winners ride. Which are the sectors, Sam, as we head into 2024 that you find less attractive here?
Well, less attractive. I still think that there's an awful lot of headwinds to be found in consumer staples, healthcare, as well as utilities. Utilities, might see a little bit of a pop because they have fallen by 11% on a year-to-date basis through last night, the worst performing sector. They do offer a nice dividend yield, but I think if investors are re-gravitating toward growth, they're going to do so at the expense of these very defensive categories. And only if we do think that a hard landing is likely, which we don't, then I think we will not see a rotation into defensive areas that will just let those winners ride.
Sam, I'm also curious, sort of circle back to the idea of the Magnificent Seven, which had been so dominant this year. Before that, it was FANG, right, as our popular acronym. Is there something that you think it's going to go towards in 2024, and we'll come up with another sort of cutesy name for?
Well, I'm sure we're going to come up with a cutesy name by all means. I don't have one at hand to offer. While I do think that, on average, the top three sectors going back to 1990, following an up year, if you stuck with them, those three on average outperformed the market 70% of those years. But I mentioned earlier honorable mention. So financials and industrials, these are showing good relative strength. They are showing positive earnings growth expectations, more attractive valuations. funds. So even the regional banks, as well as some of the investment bank and brokerage categories in the financial side, as well as the industrial machinery areas and building products are expected to do fairly well. So, you don't want to be bottom picking at this point because there's just too much overhead resistance.
Sam, one trend we saw in 2023, investors sitting in cash, and listen, for good reason. Do you think, Sam, in 2024, would you expect to see investors really pull out of those money market funds and put that money to work? And where do you think that money would flow to? Would it be equities, bonds, both?
Well, yes, I do think that we will see some money because, in my opinion, there's really only one emotion when it comes to investing: fear. Fear of losing money on the way down and fear of missing out on the way back up. So what we are going to see is just a trickling in of the money that's on the sidelines. Yes, it's earning 5%. Yes, it is fairly safe. But I think investors are going to say, well, wait a minute, I don't want to be left behind. I want to be taking advantage of these strong price moves as well. So I do think that that's why the bull market takes the stairs rather than the elevator as the bear market does, mainly because little by little investors throw in the towel and decide to invest the money that's on the sidelines.
Sam, it was great to have you on the show today. Thank you so much for your time, your insight, and Happy New Year.
Thanks. Happy New Year.
Let's check in on some of today's top trending tickers. We're going to start with Altis here. Those shares rising on a report that the company's in agreement to sell Cheddar News to the media company Archetype. That's owned by private equity firm Regent. According to CNBC, terms of the deal were not officially disclosed, but it's structured as a so-called earn-out deal. Cheddar was bought by Altis USA in 2019 for $200 million, and there's been a lot of chatter about Cheddar potentially getting sold by Altis. So this is not a shock that this is happening. What's interesting is that Altis, the U.S. shares, have had a killer month here because of some speculation surrounding the stock, and now this latest news.
Yeah, so if you remember, of course, John Steinberg founded Cheddar 2016, sold it to Altis 3 years later for around $200 million. And if you look there, still though, even with the pop though, pull back the chart here, stock is down about 30% this year still. And remember how we talked about how much the street loves certain names even after big runs this year. Even for this one, after this rough 2023, most analysts, Julie, more than 60% still a hold on this name.
Yeah, I mean, the bounce that it has seen has been a bounce off the bottom, to your point. Yeah. There was some speculation and some reports that there was an interested buyer in Altis Portugal. Altis Portugal isn't even connected directly to Altis USA. It's just that Patrick Drahi is the controller of both of those entities. So that was sort of originally why the stock had been rallying, and it's actually set to have a record month, Altis USA. But again, it is from that low base that you mentioned.
Meanwhile, shares of AMD, they are rising higher today, now up about 130% this year. So AMD is obviously, Julie, it's one of the great business stories. For a long time we talked about, it was always like AMD and Intel, David Goliath battling in the PC and server markets. And then AMD obviously really kind of changed the game there, really. You can chalk that up to Lisa Su, the CEO there. You can also chalk it up to Intel stumbling and AMD taking advantage. But now, of course, AMD has its sights set on the mighty NVIDIA.
Yeah, and that's really been one of the big stories this year, with NVIDIA just sort of running away with the AI story. AMD has slowly been gaining some traction there. What's interesting is, I think not everyone, many of the semiconductor analysts that you and I have talked to over the past couple of months, when we ask them, what is your AI-related play going to be in 2024? A lot of them have said AMD is the one that's coming up and catching up with NVIDIA. Now this year, as you mentioned, AMD's up about 132%. NVIDIA's up by nearly 250%. Yeah. What's interesting about that as well, the valuation on a forward earnings basis for AMD is still higher than that for NVIDIA. I guess in part because the P has gone so far, but the earnings estimates are keeping up here.
Yeah, you mentioned those two. That'll be a great battle to watch next year, because remember this month AMD kind of came out swinging. They had these new AI chips. They even kind of put some financial bogeys on it. I think Lisa Su said the new products They think they generate about $2 billion in revenue next year, and they're obviously very confident in their tech. They're confident they're going to be able to win over these big tech customers. Though analysts were quick to point out, NVIDIA's new offerings come to market over the next several quarters too.
Right.
So watching these two battle out will be a fun one.
Yes, it will be a fun one for us and for investors too,
Yep.
one would think. Penn Entertainment in the green today on news that one of its top shareholders, HD Vora Capital Management, is requesting the right to appoint directors to the board of the casino operator. All of this coming from the Wall Street Journal. The Journal says that HD Vora has an 18.5% economic interest, including swaps with Penn. It's interesting here because Vora is not, according to the Journal, typically an activist firm, but is stepping up in this case. You know, we have seen, if you look at how casinos have done this year, they've done pretty well, and Penn is one of the only ones that is down on the year. So that's why you see, or part of the reason that you see Vora get involved here.
Yeah, Penn was one of those names too. I mean, it surged during the pandemic when everyone is at home. When you're at home, why not try out some online gambling? But now, to your point, Julie, popping today though, even with that move, shares firmly in the red in 2023. It sounds like the hedge fund, you know, not afraid of a proxy fight if they have to here. Again, this is, you know, the Journal citing sources. Apparently, they're arguing the stock is deeply undervalued. They are not happy with capital allocation, and what they're referring to is sort of here, kind of what failed bets on M&A as well. So you could have a fight on your hands.
I mean, they are in talks, to be clear. So the fight wouldn't happen unless the talks don't go anywhere. When it comes to M&A, remember, Penn bought Barstool Sports, then sold it back to Dave Portnoy for $1. Now has partnered up with ESPN. So that's kind of some of the back and forth strategy that we've seen from the company.
$1. Yeah.
$1, not a bad deal. We're just getting started here on Yahoo Finance Live. Coming up, what consumers should be watching for in the tech market as we head in the new year, particularly in the AI space. Plus, investing in the internet. We'll be joined by a Citi analyst to break down what to expect from internet stocks in 2024. And retailers hit hard by inflation and higher rates this year, but could they be in for some relief? We've got that and more when Yahoo Finance returns. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Markets melting up into the new year. Our own Jared Blickery has been taking a closer look at where the money has been flowing. He is here with the details. Hi, Jared.
Julie, I'm not going to spoil the party here. Money market funds, cash taking in $1.3 trillion. This just dwarfs everything else. Over here we have non-U.S. equity that stocks $70 billion from around the world, but not the United States. $95 billion for American securities, and bonds, $276 billion. But as I said, just a fraction of what money market funds took in this year. But it's not all in equity it's not all in the money funds. SPY came back in December. We saw $40 billion or thereabouts in inflows, and that is the greatest amount ever. So if we go back to the slide from before, this tiny little sliver down here, 1 month of SPY was a significant portion of that. So keep that in mind because as we come out of the fears of 2022 and the realization that we're either in for a soft landing or a no landing, the dynamics change a little bit. And I want to show here. Cash demand moves with recession probabilities. In purple here, we have 12-month. This is a rolling 12-month of money flows going back all the way to 2012. And in cyan here, we have the New York Fed, their 12-month ahead recession probability. And this is informed by the yield curve, various inversions in there. So we can see we have a big spike up here. We've had the greatest inversion in decades. So not surprisingly, we've seen this peak here, but we also see an inflection down. And on a lagged basis, we're also seeing the money flows, those money flows into the money market funds, that is slowing down as well. Will the trend continue? Safe to say it's probably going to continue for a few months, but it could inflect back up again, or it could go sideways. But I think it's instructive that here, remember back in 2018, 2019, we had a yield curve inversion. That was actually late 2019. And in 2020, in fact, we did get a recession, but of course that was a pandemic, something totally different. But as fears came down, as money market funds became less in vogue because investors got a lot of FOMO, saw all that action on the sidelines, guess what? That money flowed back into equities. And so Goldman Sachs reminding us, and this goes back to 2007, this is money market fund, retail money market fund assets. When we had this decline in money market fund assets in 2009, 2010, 2011, that was a huge tailwind for equities. That was the beginning of that great bull run. And so here was that building period, and then that was a release. Well, look at the building period here. We have two different legs from 2017, and then from about 2021, 2022 on. This could have significant tailwinds for any asset class around the world, and we'll just have to see where that gets back to. But I keep centering on this chart right here. Just an unbelievable amount of money came into cash this year.
Jared Blickery, thank you for that. Appreciate it. Meanwhile, the Magnificent Seven dominating markets this year, and now as investors searching for returns in other pockets of tech. And our next guest says one area they might turn to in the new year is internet stocks. Yigal Arounian, Director of Internet Equity Research at Citi, joining us now. Yigal, it is great to see you. So strong year for your coverage universe, Yigal, average return about 40%, and you see that momentum continuing, Yigal, in 2024. How come? Walk us through the reasons.
Yeah, certainly. So 2023 was a great year for internet. It was a rebound year off of was a really tough 2022. Like you said, Josh, our coverage across about 50 internet stocks was up about 40%. A lot of that was really driven by, like you said, the Magnificent Seven and larger cap internet stocks. We think the fundamentals within the internet universe are continuing to be strong. If anything, they'll strengthen into next year. That includes share gain across a number of sectors like e-commerce, like digital advertising, like website builders, for example. And all the momentum that's kind of driven internet over the last few years should continue. Now, in a better inflationary environment, better consumer environment, hopefully as we kind of get through this last leg of a more challenged consumer, lower rates, I think all that supports growth within internet stocks. We saw a good amount of multiple expansion in 2023, but we're still below historical averages across the internet sector. So there's more room to run within multiple expansion, and we think we can start to see upward estimate revisions. We think all that sets up for a really good year in 2024 across internet. And then one of the last things is that so much of the gains have been centered within those larger cap stocks, and we're already starting to see investors focus on a broadening of investments and looking for more outside of those. And we think all of that really sets up for a great year in 24.
Yigal, it's Julie. It's great to see you. One of the other things, of course, that was a big theme this year has been generative AI and the sort of birth of the excitement around it. How do you think that's going to play out for your coverage next year? How are these companies going to start using it? How is it going to help them? What kind of changes do you think we're going to see here?
Yeah, so generative AI obviously burst onto the scene this year. And one of the things that I think we'll see more of next year is actual real implementation of AI across different end businesses that will start to drive more meaningful change. So this year is kind of here's Gen AI, here's what it is, and everyone's starting to learn and figure it out, especially among the investor community. There was a lot of debate on who would be the Gen AI winners, who would be the Gen AI losers. And as we've kind of gone through the year, we've started to understand a little bit better how it'll actually impact different businesses. And so I think we're going to see a lot more of that in 2024 that will impact different companies and different businesses in different ways. But we think that's going to be a huge thing next year.
So let's get some picks here for viewers. One name I thought that was interesting, Trade Desk, Yigal. And that one, you got to buy on that name. It has roared higher this year. It's up about 65%, but you like the name. So you see it moving still higher in 2024?
Yeah, Trade Desk has been really a phenomenal company, a phenomenal investment over the last couple of years. One thing is just that at the macro level, we saw a rebound in the ad market this year. We think that continues next year. We've done surveys of advertisers, of SMBs, and the intent to spend, to accelerate advertising spending next year is moving up, and it's moved up over the course of the year. So 2023 was a better year than feared in digital advertising. I think that can continue, especially if we're in a soft landing, no landing scenario, which seems a little bit more increasingly likely. So a better ad market next year. There's a political spending next year that helps. And Trade Desk is really centered, their growth is centered around the shift from linear TV to streaming TV. And they are very well positioned there. That's really early days in that shift. Even though you're seeing about 50% of viewership now on streaming, the ad dollars are lagging. We're maybe about 30% of TV dollars are spent on streaming versus traditional linear, which is about 70%. I think we're still very early days, and Trade Desk is very well positioned within that.
One of your other top picks going into next year is Wayfair, and that one caught my eye because we have seen such cyclicality in sort of the online furnishings market, right? So do you think it's a normalization period for Wayfair, or do you think we're actually going to see a boost to growth here for the company?
I think it's a little bit of both. And one of the most interesting things for Wayfair is that it's been in what's been probably the most challenged consumer end market, right? Home furnishings. It's continues to be down significantly year over year. But a lot of that is still on kind of deflationary pricing. If you look at orders across the industry, we're flattish. But overall, that sector has been pretty challenged. Wayfair is positioned pretty well within that. Over the past couple of quarters, they've been taking share, and they've been faced with a lot of challenges, supply chain challenges in particular over the course of COVID. A lot of that has normalized, but we expect that continued shift to e-commerce. Wayfair is really positioned really well within that. So we do expect some normalization. It's been almost 4 years since everyone was locked at home and bought every piece of furniture that they needed for their house. So I think we'll get some sort of renewal cycle. Consumer starts to get healthier over the course of the year. And then, a lot of the Wayfair investment is also about improvements in margins, some cost rationalization that we've seen this year. There's a real kind of path forward to real improvements on the margin side. We think that will play through this year, which means a lot of the story and the challenges around burning cash and negative margins that have played out over the past couple of years really start to improve, and the company can get to much more solid grounding, fundamental grounding in 2024.
And Yigal, I want to get you out of here on one last pick. VeriSign, another name you like. That stock is going to finish the year, Yigal, basically flat here. What are the catalysts you think that move this one higher in 2024?
VeriSign's an interesting one to finish off on for sure. What we've seen from VeriSign is over the past couple of years, the trends within the .com and .net domain growth, which is where their business centers, has been soft. We've been expecting to get back to some more normalization within the domain growth environment. It's starting to play out a little bit, but .com in particular has lagged. We still think that that'll improve over the next couple of years. .com remains the dominant domain. As the health of the economy gets better, we'll see more domain registrations, more businesses starting up. And then one of the best parts about VeriSign is that it's got incredible margins. It's a 75% EBITDA margins. They generate a lot of cash. It's a really safe play. So it's a stock that we really like, both on the cost side and on what's been under normal growth, let's say, over the past couple of years, that we think will start to get back to that normal growth rate.
Yigal, great to see you once again. Hope you have a great start to the year, and we'll catch up with you soon.
Thanks, guys. Great to be back.
Thanks.
Happy New Year.
You too. Coming up, mortgage rates remain on a downward trend heading into the new year. So what does that mean for buyers and sellers as we turn to 2024? We'll discuss on the other side.
The U.S. consumer has proven to be more resilient than expected in 2023 amid lingering inflation. However, some risks may be on the horizon in the new year. Here with the details is Yahoo Finance's very own Madison Mills. All right, what are they, Madison?
Well, you might remember a year ago, the big banks were saying we're definitely headed towards a recession. We're worried about the strength of the consumer. Not so much this year, as we heard in those bank earnings. We're still seeing some consumer strength, but some interesting data from the Federal Reserve of New York showing that credit card delinquencies are up across every single age group. That was following the bottoming out of those delinquencies in 2022. This could be related to that stimulus money starting to run out, the return of student loan repayments, also due to just the consumer starting to potentially buckle under the rapid inflation that we've been seeing across the board here. I also want to point out that the banks have been saying that not only is consumer credit spending up, it's also taking consumers longer to pay back their debt. So that could be an indicator of consumer pain starting to trickle in here. But then when you hear Jay Powell talking about Fed rate cuts, it seems like the bad days might be behind us.
Well, and what's so funny about all of this is the banging of the drum over the summer was student debt repayment is coming back, all of these other things, the chickens are coming home to roost, people are going to stop spending.
Yeah.
And that didn't happen. So I feel like every time we get these sort of like, the trouble is, I mean, that doesn't mean it's never going to happen.
Yeah.
But I don't know. I think the antennae are up after the year that we have had, right?
And the holiday spending was up. We had MasterCard saying it was up 3.1% heading into December 24th. So I just have to wonder where the call is coming from inside the house. When you're seeing the consumer continue to spend, it reminds me of the commercial real estate ghost in the room. Like, which one is going to start to be the thing that we have to really worry about next year? Yeah. Maybe it's credit card debt.
Maybe it is. We shall see.
Yeah.
Thanks, Maddie.
Yeah,
Appreciate
of course.
it.
Thank you.
Well, it's a busy day for housing news. Mortgage rates falling in the latest week, now hovering at 6.61%. And it comes as we learn pending home sales held at a record low level in November. Joining us now is Melissa Cohn, William Ravis Mortgage Regional Vice President. Thanks for being here, Melissa.
My pleasure.
When do we start to see more of an effect from these falling mortgage rates here?
Well, I think certainly after the holidays. You know, it's been quite the year, and I think a lot of people are enjoying the Christmas, New Year's holiday, and will really get back to the business, the real estate business, and other business after the new year. You know, we had that point in time where rates were so low, and people had to, scramble to buy a property because it's on the market, and if you don't buy it now, it's going to be gone. You know, and then that changed, and people have more time now to look at a home and think about it, and make a decision after seeing 5 homes or 10 homes. And I think people are taking their time, especially with the sense that mortgage rates are going to continue to come down over the course of the next 2 years. There's no urgency because we haven't seen the bottom yet.
So, Melissa, to your point, I'm looking at the 30-year fixed here. According to Mortgage News Daily, we're back to 6.63. I'm interested, Melissa, though. So, obviously we're off those highs, but in order for this market to start working again, we also need to see just more supply. What does inventory look like right now, Melissa, and what do you expect in the months ahead?
There's a total dearth of inventory. People, so the majority of this country own mortgages with rates that are below 5%, many below 4%, even at 3%. And those people are not ready to move. They don't want to go from a 3% rate into a 6% rate environment. I think when mortgage rates come down, let's say get down to like a 5.5%, then people will start to think about perhaps it's time to sell, take advantage of all the equity that they built in their homes over the course of the past few years. We also have to remember that people move for life cycles. People get married, they get children, they get divorced, the kids move out of the house, people die. So those people are always in the real estate market, but there's just not enough inventory because people don't want to give up their low rates.
Yeah, Melissa, obviously you're in the mortgage business, and as you know, feels like ARM's adjustable rate mortgages really got a bad rap, post-financial crisis. Are we going to see a comeback of those types of loans here because people are going to be anticipating that rates are going to fall?
So a lot of people do take adjustable rate mortgages, but they're a little bit harder to qualify for. And now with the way rates have dropped, some of them are not significantly lower than what a 30-year fixed rate is today. But if you can find an adjustable rate where that rate is 0.75% lower than the rate on a fixed rate, so if you can find an adjustable rate at 6 or in the high 5s, you may want to consider taking that today if you can qualify, because interest rates, as I've said, are going to continue to come down, and people are going to end up refinancing the mortgage that they have today over the course of the next 2 years.
And I also know, Melissa, one thing you tell people is, what's most important, the features of a loan. What do you mean by that? Walk us through.
So first of all, when you take a mortgage today, you want to make sure that if you lock in a time of application, that you have the ability to float down your rate, meaning that between the time of application and the time you close, that you can take advantage of lower market rates, because the expectation is that rates are just going to be on a downward trend. But there are also some banks that offer a very interesting post-closing feature, and that is that they will allow you for a small fee to modify the rate that you have on your mortgage without refinancing, which is great because A, it saves you money, and it also saves you the hassle and the headache of having to go through the refinancing process.
Melissa, helpful insight there. We appreciate it. Thank you so much for joining us today.
My pleasure. Thanks for having me.
Coming up, will investors continue to reap the rewards from the tech and AI space in 2024? We'll discuss what to expect on the other side.
Markets are pricing in Fed rate cuts starting in mid-2024. Equity investors are already placing their bets on which companies will win and lose. Utility stocks, for example, have started to rebound as bond yields have come down from their highs. Don't get caught behind the curve, the yield curve, that is. Which stocks should you pick up as rates stabilize and which should you avoid? We'll tell you in our new Yahoo Finance series, Goodbye or Goodbye. 3 times a week, you'll get insights from investing pros on how to build your portfolio.
Tech having a huge year in the stock market in 2023, particularly in the AI space, with a frontier of potential growth on the horizon. We could see a new Magnificent Seven come into focus. For more on what investors should watch for in the tech market going into 2024, we turn now to Tech Analysis Research President and Chief Analyst Bob O'Donnell. Bob, it is always good to see you, my friend. There were a few big trends, Bob, in 2023. We could start in a few different places, but let's start with AI. A boom of interest there in 2023, Bob. We saw all kinds of companies putting time and money and effort into that tech. As you look ahead in 2024, Bob, I'm interested, how do you see generative AI as a technology evolving, Bob? And what are some of the companies you think are poised to benefit from that?
Well, hey, Josh, first of all, great to see you again. Yeah, look, we had obviously this explosion of interest in Gen AI. But what I want to point out to folks is that most people in their jobs have yet to really experience it because, you know, Microsoft Office and Google Workspace, these are the tools that most people use every day in their normal work environment. And we're just barely starting to see the rollout of the Gen AI powered versions of these tools. So I think, you know, despite the fact that some people are saying, hey, we're going to see a pullback on the hype, I actually think we're going to see a bit of more of an explosion of interest around Gen AI as the general populace starts to use these tools. So, you know, again, Microsoft, it's Google. Those kind of companies are going to be important. You're going to see OpenAI and the other companies associated with Microsoft and Google. You're going to also see other areas in the enterprise. We're going to see Amazon. We're going to see Meta. We're going to see all of these companies that have been working on developing the large language models and tools for them to be deployed in the enterprise. There's lots of interesting new developments that I think are going to be important moving forward.
And Bob, so you mentioned some names there. You know, you mentioned Microsoft, you mentioned Google. Where is Apple in this conversation, Bob? And do you expect to hear some news from Apple maybe in 2024 about this?
I do, Josh. Here's the thing. I think Apple is behind the curve on this one, to be truthful. I think we'll see them they'll have announcements, I'm convinced, in 2024. I'm guessing perhaps second half of the year. We'll see exactly. You know, at the WWDC, their developers conference, which is typically June, July. But, you know, they don't have that mainstream productivity tool. And one of the things I do want to emphasize, I forgot to mention, is that most of that impact, of course, I'm describing is in the enterprise. We've talked a lot about consumer impact. I think the consumer impact of Gen AI is actually going to take a little bit longer. I think we're going to see more of it in the enterprise, and Apple doesn't simply have that strong of a position there. Eventually, we will see, of course, you know, Apple services that are Gen AI powered, just as we're starting to see that from some of these other big players. But I do think it's going to be a little bit of a tougher year when it comes to Gen AI for Apple in 2024.
But hey, Bob, it's Julie here. Is 2024 going to be tougher for Apple on multiple fronts? I mean, they're now coming into the year with, yes, they got a stay on the ban of sales of the Apple Watch, the patent for which is in dispute for a particular type of pulse ox technology. There's that happening, though. That fight's still ongoing. There was an interesting story in the Journal today that focused on how Chinese phone makers are now getting into the auto market, something that's been speculated upon but not acted upon from Apple for years. Like, what are they doing? What is 2024 for Apple?
Well, you know, it's a great point, Julie, and it's kind of fun. This car, and I saw that car piece too, and it is very interesting, you know, because years ago, everybody expected by now Apple would have a car or some sort of car-related technology other than CarPlay. And of course, so we saw a lot of its Chinese competitors jump in and actually do something that it turns out Apple didn't do. And we'll see how well that plays out. Because there were always a lot of questions of how successful can a general tech company be when it comes to automobiles? Because there are a lot of differences there. So we'll see what happens. But it is very interesting to see these Chinese competitors. Look, in 2024, Apple's going to have the Vision Pro, you know, their VR headset. But it's going to sell in very small quantities. It's very expensive. You're going to have a very personalized sort of one-on-one approach to that. They've acknowledged that maybe they'll build 400,000 next year. I mean, that's not a whole lot, you know, of units. That's not going to move the market. And again, you know, we've seen iPhone sales have started to stall. The Mac had a good couple of years. I think that's starting to stall. You know, one of the other things I think in 2024 is AI PCs, and that's going to be more on the Windows side. I haven't seen anything from Apple to suggest that they've got an AI accelerated Mac coming just yet. So I do think it's going to be a bit of a challenging year. But look, you can never count Apple out. They're incredibly good at what they do. They're going to find niches and ways, and they will tell their story around Gen AI in 2024 in a way that's going to keep them relevant. So, it's not like when Apple has a bad year, it's kind of all relative, right? It's not a horrible year. It's just going to be a little tougher, perhaps, than we've seen them have in previous years.
Yeah, Bob, and to your point, Apple's had listen, it's going to notch a strong 2023. Key question, of course, is, can Tim Cook get that top line growing again? That's where the debate is. I'm also interested, Bob, to get your take as we look ahead to really sticking with Apple here. As you look to 2024, your outlook, Bob, on just the broader smartphone and PC markets. How do you think those markets perform in 2024? Because, of course, that has critical implications for all kinds of tech companies.
No, absolutely, Josh. And look, I think the smartphone market is kind of in this lull stall thing. And until Apple does something radically different, like a foldable iPhone, which I am convinced they will do at some point, and then everybody will be like, oh, wow, foldables. Of course, they've been out for years from Samsung and other vendors. But anyway, I think it's kind of tough because right now it's very incremental. And everybody is like, oh, wait, is that the 12, the 13, the 14, or the 15? I can't really tell anymore between those phones. So that makes it hard for people to really appreciate the differences. On the Mac side, again, I think they are going to be a little bit challenged. They've had a couple of good years. The latest silicon from Apple is incremental, but it's not a huge improvement. We've got a lot of exciting PC silicon coming out this year. We've got Qualcomm has already announced their part, the Snapdragon X for AI accelerated PCs. Intel just announced a part. AMD just announced a part. I think things are going to get interesting in the PC business. And again, more on the Windows side than I think on the Mac. So yet another challenge for Apple. So the question will be, to your point, what drives that top line revenue for them? And I think there's still some serious questions.
Bob, I want to come back to something that you said that sort of feeds back into what you're talking about, which is that 2024 is going to be more interesting on the enterprise side than on the consumer side in terms of innovation, in terms of pushing things forward. What are the sort of implications of that then? Are we going to see consumer try to then, borrow some of those lessons going into 2025 and beyond? How should investors be thinking about that? That's sort of an interesting way to frame what we're going to see from the coming year.
No, you're right, Julie. And I do think we're going to see some interesting experiments in 2024 when it comes to consumer for generative AI, because, right now we've all gotten past sort of the parlor tricks of, create this cool image or create a haiku with, the following 8 words, and everybody's kind of done that. And that's fun, but it's not that useful. The practical stuff is going to be on the enterprise side. Help me write these emails. Help me generate these reports. Make my job of analyzing this data easier. All of those things are going to happen in 2024. The question becomes, how does the consumer market kind of learn from those? What are the things that can be taken there? There will be infrastructure put into place by all the big cloud guys and a bunch of other companies to power this AI. That is, and then the one caution we have to be aware of is, with the Taiwanese presidential election in January, there are concerns with what China has been saying about trying to, reincorporate Taiwan. Does that impact the semiconductor supply chain? Because you need a lot of chips to do the AI, whether it's for enterprise or consumer. And if anything happens there, that could be a serious impact, not only on tech, but on automotive and lots of other industries. So we have to be a little cautious about that. Not crazy, worried, but just keep an eye on it, kind of a thing.
And finally, Bob, I want to get you out of here on this, your thoughts on China, and not just, for next year, for 2024, but really kind of long-term, Bob. I'm interested to get your take on that market. You look at that economy, it's shaky. You have intense geopolitical tensions between Washington and Beijing. For American tech companies, really, Bob, for Western tech companies, should they long-term still think of China as this big, potentially lucrative market? Or no, they should think of it as maybe it's smaller and lower margin than they used to think about it?
Well, it's a great question, and there's no simple answer to that, Josh. But I mean, look, it's still an enormous market. It's still going to be a large market in 24, in 25. What's it like in 26 or 27? Those are, I think, are the bigger unknowns. It is a challenging market, right? Given all the restrictions we've seen on certain semiconductor technology, Chinese consumers still seem happy with a lot of Western brands. Of course, we're going to see more pressure politically to drive people away from those and towards Chinese domestic brands. And so that's going to certainly play an impact. So I do think companies are starting to reevaluate their China business. And I think longer term, there'll be an impact. I think in the near term, generally speaking, I think it'll be okay, unless, again, there's some dramatic geopolitical issue that changes everything in an instant, which unfortunately is always a possibility you have to think about.
Bob O'Donnell, great to see you. Happy New Year to you.
Thank you. Happy New Year to both of you guys, too.
Thank you. We'll talk to you soon. Coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned. There's the closing bell on Wall Street. Let us do a quick check of the markets. And it looks like we're losing some steam here into the close of trading. So the S&P 500 not quite as close to that closing record as it was. It looks like the Dow, though, will likely close at a record here. The Nasdaq pulling back by just 4 points here as we head into the close of trading. So obviously volume tends to be low on these waning days of the year here. Utilities and real estate, so interest rate sensitive stocks leading what gains there were today. Energy stocks, though, lagging on the session. And just speaking of volume there, just checking out the volume here across the board, we're looking for the S&P volume at about 28% below the 100-day average. Not surprising here. A lot of folks are away. They're not trading on these last few days
They're on the slopes
of the year. But as we've been discussing, the direction for stocks has generally been this little sort of melt up or creep upward in these last few days.
We did just talk to market guru Sam Stovall, who seemed to think near term He's looking at different indicators, could be set for kind of a breather here. Longer, I mean, 2024, he sounded pretty constructive, but near term, some flashing yellow lights, according to Sam.
We'll see how near term those materialize.
Moving on, let's get some tickers, Julie Hyman. Let's do that.
do it.
Kathy Woods, ARK Investment, shaking up its crypto holdings. The asset management company picking up shares of ProShares Bitcoin Strategy ETF while dumping its holdings of Grayscale and selling shares of Coinbase. So this is interesting. I mean, Kathy Wood makes moves. It gets attention, Julie. We know that. So Kathy Wood's funds making some changes. Bitcoin-related holdings. ARK Next Generation Internet ETF looks like sold all of its remaining shares of the Grayscale Bitcoin Trust, but made some buys too. Bought about 4 million shares, it looks like, of the ProShares Bitcoin Strategy ETF, which obviously that invests in Bitcoin futures. Wood telling reporters that the move was made in case Grayscale Trust conversion to an ETF isn't actually approved by regulators in January.
Which is so fascinating because she just told us earlier in the week that she's been relatively confident, cautiously confident, that her own offering for a Bitcoin spot ETF in cooperation with 21 Shares would be approved. And she's also said consistently, as have other analysts who follow the space, that they're all going to be approved at once, that the SEC is at pains not to show favoritism in the order in which it approves some of these ETFs, that it would approve a bunch at once. So it's interesting that she's sort of hedging her bets on this. Of course, she will be in more direct competition with Grayscale if it is approved and her ETF is approved. The two would be in competition. They're both spot Bitcoin ETFs. So it's interesting here that she is making this move. She's doing a couple of other things here. She did buy also some shares of, again, the fund that she runs with the partner 21 Shares, that's a futures product, and also sold some Coinbase shares, which is still the top holding over there.
Yeah, and Grayscale actually used to be the top holding in the ARK Next Generation Internet ETF, which right now looks like it's up about 100% on the year.
Yeah, just one more quick note here. When we talk about ARK, we usually talk about the benchmark ETF, ARK-K. This is, again, the next generation ETF. It's smaller, about $1.8 billion in market cap. ARK-K, the innovation fund, is $9.7 billion. So this is a smaller ETF that her firm runs as well. Well, Boeing is urging airlines to inspect the company's 737 MAX planes, the aircraft manufacturer asking to check for possible loose bolts. The shares are not taking that much of a hit here, down by about 2/3%, but it is just sort of the latest question about quality control. The company had some issues earlier in the year with Spirit Aerosystems, which is a maker of parts that go into Boeing planes. So, you know, it's just kind of been, the stock is up on the year, but there have been some lingering questions about it getting 737 MAX off the ground.
Yeah, this is a story about loose bolts. That's what we have here, or potential loose bolts.
Yeah.
I think that's, and it's important to say, you know, reports that I'm reading, Boeing did say the issue here on a particular plane already been remedied.
Yeah.
It sounds like they recommended inspections out of what they were calling just an abundance of caution. But of course, the backstory here, when you talk about the 737 MAX jets, you know, they were grounded after these crashes in 2018, 2019. The FAA then finally did approve changes to the design, said, look, okay, you're good to fly again after about 2 years. By the way, good year for Boeing. I mean, if you've been long that name, the stock is going to finish up about 40% in 2023.
It is, but it was down for the 3 years prior to this year. So it's definitely a rebound recovery play, at least in the eyes of investors this year.
And really, despite that move, the street is bullish. I mean, just to tell you, I mean, 26 buys, 6 holds, no sells.
Wow, okay.
Finally, Mullen Automotive delivering 50 Class EV cargo vans, invoicing Randy Marion Automotive Group for about $1.7 million. I think we had, remind me, Julie Hyman, did we have StockTwit's CEO? Didn't he mention this name as?
He said it's the top trend. I mean, it's the top
big
ticker.
Trender.
Yes,
they
big
like
trender
talking
on
about
the
it on
StockTwit's
that
platform. Yeah.
So Mullen hired today, and that's the headline we're seeing. They delivered about these 50 EV cargo vans. They're going to deliver more vehicles soon. The stock's jumping, though of course, context here, it's still down about 99% in 2023.
I mean, yes, context is everything. By the way, we already knew that they were going to deliver the vehicles because we talked about that, I think, last week.
Yep.
Now they've actually delivered the vehicles,
Yes.
and the stock is up again. You want to guess at the market cap of this thing?
What, tell me.
$58 million.
Yeah.
This is a teensy tiny company. I view Mullen as the meme stock that wouldn't die. It's like the one that keeps popping up. Yes, we talk about GameStop sometimes too, yes. But Mullen is like the teensy tiny little company that for some reason people are still paying attention to.
Stock was around 600 at one point.
Well, not anymore.
But you know what? It's a topic of great conversation on StockTwits.
And on our platform, it's trending on trending on Yahoo Finance as well.
It's a talker.
It's a talker.
Right. Moving on, it has been a testing year for the EV agenda as automakers and consumers reassess the move toward electric vehicles. From a slowdown in sales momentum to a pullback in investments, we're taking a look at the bumpy road for EVs as we put 2023 in the review mirror there. And look ahead to the new year. Here to discuss is Bill Newman, SAP North America Automotive Industry Executive Advisor, along with Yahoo Finance's very own Praz Submaranian. Bill, it is good to see you, and I'm going to start with you here, Bill. So you look at 2023, it looks like, Bill, consumer demand for the EVs, at least in North America, kind of seems to be waning here a bit, Bill. What are the issues, and do you expect that to change in 2024?
Yeah, so first of all, Happy New Year, everybody. I think what we saw in 2023 were some pretty interesting headwinds. I think some of the supplier elements were balanced, so that's good. But I think people, as you just mentioned in your last segment, found, you know what, hey, building vehicles is can be tough, particularly if you're a new company that's starting out with it. I think that many of the early adopters in the light passenger space have already bought or put their money down on a vehicle. And I think what you're going to find is that you get to that next level adopter, they're going to look to things like battery density, eliminate range anxiety, try to find some additional electric vehicle charging stations and network. You know, going from 200, 500 charging stations to 20,000, 500,000 is a whole different matter. So I do think that there's been a little ebb off the hype curve there, and I think that some of the OEMs are starting to reconsider what their portfolio and volumes will be going into 2024.
So, Bill, you mentioned some of these headwinds, and we saw companies like Ford and GM pull back on those EV investments this year after, highly touting them for a year or two before that. What are some of the things that you're seeing from like a headwinds point of view that continue going into 2024? I mean, we're seeing EV sales growing, but they're also sort of not growing fast enough. Is it more of a case of high prices, high rates, things like that?
Yeah, you bring up a really good point, Pras. I mean, you're in the upper segment now for most of the EV offerings. So you mentioned General Motors. General Motors just went through their culling of their Buick dealerships. Half of them won't join the EV journey. So you kind of have to get that square right with your distribution framework. Guess what? We also had a little bit of a labor discussion. Thankfully, it ended up before Halloween. But guess what? That price factor is being built in, and it doesn't matter if you were part of the UAW or the Canadian discussion. You're also being part of the opt-in. So all the people who are not unionized are building in 9, 10, 12% labor costs uplifts. That all has to be pushed down into the suppliers. Suppliers have a lot different elements to build in terms of EV, less mechanical parts, in many cases, very different design elements. So it's really going to be interesting to see how it all shakes out, not just from the consumer side, but from the supplier sourcing side.
From the supplier sourcing or also the OEM side, you mentioned before, I think, that there's going to be more, discipline from the OEM side on spending, depending on basically saying that they don't want to spend so much on certain things. They might outsource some things. What are some of those sort of factors that you see the OEMs shifting outward for?
Yeah, well, I think it's the old conversation of going back to core capabilities, right? Obviously AI plays a huge role in this, particularly from our company, SAP. We're very active in the business AI perspective. So what does that look like, right? If I can buddy up with a bot, right? And I can actually team together, robot and human to tackle larger problems, more high data density. What does that look like, right? So in a way, there's some of this light sourcing that can be done with AI, but for sure, talent's going to remain an issue, right? I think we need to get square on an immigration policy at some point. Leaders are doing what they need to do to get make that happen, and whether or not that's sourcing across NAFTA or bringing in company employees to do certain amount of work on short periods of time, you're going to see that as well. But as I like to say, for those people building in the South, that kind of car building capability, you can't pull somebody out of fast food and retail and expect them to build cars right away, right? It's a learning process. So we're at the first part of that learning process from an industrialization perspective, and I think we need to keep an eye on that for the next 2, 3, 4 years.
And Bill, I also want to get your take on the market over there in China for EVs, and names like BYD. Bloomberg saying BYD will actually surpass Tesla as the new worldwide leader in EV sales, likely in the current quarter, Bill. How do you see that market in China evolving? I mean, it certainly has the support of the government over there. How does it evolve, Bill? And what does that, by the way, mean for U.S. companies like Tesla?
Yeah, right. So, if you build to market, obviously China is one of the largest markets in the world. Interesting industrial point from respect to China. China actually has quite a bit of electrical grid potential available. And so they don't frankly build as many combustion engine cars. So their electrification is very nuanced around their government policy and their energy policy to have many power plants that generate the electricity versus trying to be part of the petro economy as many of the rest of the world will be, frankly, for a very long time. So I think there's that, and I think that you're also seeing some, not just in China, but you're seeing some of the Asia Pacific companies, VinFast is one, take advantage of some of the IRA funding and some of the infrastructure bill opportunities available to help offset some of their expansion in the world's largest market right here in the US and North America. So again, very interesting to watch. You're right, keep an eye on China, but also see how they play into this market. Two very different markets, two very different energy frameworks, and two very different industrial policies.
So Bill, sticking with or looking at the United States here, what do you think are some of the big catalysts next year that could drive some EV growth? For instance, is it the point of sale EV tax credit happening at the dealer level? Is it maybe finally more cheaper EVs coming? What do you think is going to sort of drive more sales potentially next year?
Yeah, well, I think you hit on a few of them right there, and so let's double click on those, right? So obviously there's range anxiety, so getting above that 500 mile per charge. So I think there's some really good innovations that are coming out that we've seen developing, not only just with respect to battery technology from precious heavy metals, but also from synthetics, silicone, for an example, other designs. I think you're going to see pushing into that mid-range. We mentioned earlier in our conversation here that most of the EVs have been in the kind of the luxury category, and so now as we start to push in, keep an eye on GM's Equinox, right? I can. Depending on what kind of luxury I want, I can, push into that for under 40K. Now you're making that available. Also keep an eye on interest rates. Interest rates for car and homes seem to be taking a bit of a pleasant drop in the last, 3-4 weeks. So obviously the Fed has an influence on that. And again, just, keep in touch, around the availability for charging, and as I like to tell, my kids who are grown adults, if you really want to make a difference now, you can still look at a plug-in electric hybrid. I know it's not cool as, maybe some of the other models that are out there. Sorry, I'm just kind of, more mature in the market here, but they are California 2035 compliant as well as many parts of other countries. So maybe there's some additional options that just people haven't thought of because we've been so caught up on the hype curve, right?
Bill Newman and Yahoo Finance's Pras Subramanian. Thank you guys both for joining us today.
Thanks so much. Thanks for having me.
The Dow closing at a new record high. Now let's get a check on what stocks are at new highs as 2023 wraps up. Here are the details. Yahoo Finance's Jared Blickery. Hi, Jared.
That's right, Julie. Nasdaq 100 missed that record just by a hair, but it's impressive to see how all of these have stacked up and come to record highs throughout the year. And up first was the tech sector. And what's really interesting is that tech and home builders kind of went neck and neck. The Mag 7 for all of what we talked about them were met with several home builder stocks, and I'll show you that in a second, that were just kind of going up with them into July. Then there was a period of recess, and then they ended up exploding in November, December, and that's what we're looking at now. But we're also seeing chip stocks, that's stocks at a record high, 67% for the year. Covered home builders and tech. Want to talk about infrastructure? We got Pave, that's up 30.7%. European financials, the Dow. You look at defense and aerospace, that's the ITA ETF. Gold, we were just talking about that, reaching a record the other day, and also insurance, although this peaked a couple weeks ago. So these are all record highs within the month of December, and these are individual stocks. This covers everything in the S&P 500, the Nasdaq 100, and meme stocks, so it's not completely representative of all U.S. stocks, but it's pretty close. What's really interesting, I was talking about the home builders. Here's Builder. This is highly levered to the building sector, and we can see this is a stock that rose through July, had a little bit of a comeback there to the downside, and then really went off to the races starting in November. That's very similar to this chart of Apple. I'm just going to show you the market cap weighted view here. Very, very similar charts. Apple didn't quite surge as much as some of the others as part of the year-end sprint here, but definitely worth writing home about, up almost 50%. Let me go back to the equal weighted and just kind of show you what a broad swath of industries we have seen these record highs take place in. So Pulte Group, that's number 2. That's also in construction, but then we have PanW, Palo Alto Networks, a software company, up 111%. Chip stock, AVGO, Broadcom. Then we have FICO, Fair Isaac, that's in the financial sector, and it goes down the line. Booking, here's one, up 76%. This stock, pretty impressive, completely different industry than the others we've been talking about. We got Lennar, another home builder, up 65%. What's been interesting too is to see some of these smaller or these smaller return stocks really finally come into their records towards the end of the year. Here's General Dynamic. It's only up 4% for the year, and you can see it spent almost the entire year in the red, but it has finally climbed back here. And if you look at a max chart, you can see this is, they build submarines, but this has been kind of a volatile stock throughout the pandemic, but nevertheless, we're at a record high here. Here's another one, Textron up 14%, AME up 18%. Let's take a look at Ross Stores. This is a retail name. Let's take a look at the year to date. I think this was in the red for much of the year. Then we came alive starting just before September and then really exploded towards the end of the year. I guess the closing comment here is you can't really predict what's going to happen at the beginning of the year with a lot of certainty, because I don't think anybody would have expected this towards the beginning. I will say, however, we are still in the midst of the Santa Claus rally. If we do manage these last 5 trading days of the old year and the first 2 of the new year, if we manage to close green, that's somewhat predictive of a year-end close in 2024. But yeah, don't quote me on that. It's a little bit far away.
This is why I have a no predictions policy on a personal level.
I got to
Jared.
get one of those.
But I'm happy to ask lots of other people for theirs. Thank you. Appreciate it. Coming up, we asked the Yahoo Finance audience, speaking of which, to predict which were the biggest stories of 2024, what they'll be. The top 10 answers, we've got them on the other side.
As the new year approaches, we're also entering an election year, of course. Yahoo Finance senior columnist Rick Newman is here with a look at what Yahoo Finance users are watching next year. Rick.
Hey guys, well, we did a survey of the Yahoo Finance audience, asked mostly multiple choice questions, but we did ask one open-ended question, and that might have been where we got the most interesting answers. We said, what do you think some surprises might be in 2024? And of the top 11 answers, 8 related to politics. 3 out of those 11 were Donald Trump or some version of Donald Trump. Only 2 were about Joe Biden, even though he's the sitting president. The 3 phrases or words that did not relate to politics were AI, war, and recession. So those are some of the things on people's mind. It's very clear that even our audience focused on markets is really thinking a lot about the election. Donald Trump, he controls an inordinate amount of mind share. A lot of that is negative. A lot of our audience in the open-ended question said Trump goes to prison, Trump gets convicted. Somebody said Trump flees to Europe, things like that. A lot of them don't want Joe Biden either. And one of the multiple choice questions we asked, who do you think will win the 2024 election? Trump got the edge, but about 1/3 said somebody else other than Biden or Trump. And that, of course, reflects other polls showing Americans don't want the same matchup they had in 2022. Going to markets and the economy, our audience is pretty optimistic, frankly. We had solid majorities that think the stock market is going to rise, with a considerable minority saying it will rise by more than 10%. A majority thinks inflation will be below 3%, unemployment likely to stay relatively low, according to our audience. And those things are looking pretty good. So not everything is terrible, according to the worldview of Yahoo Finance audience members.
So we always talk about how accurate or inaccurate Wall Street strategists are. How are our folks? Because you surveyed them last year too.
Yeah, here are a couple things they got right. First, they said 2023 would end well. That was a majority view last year, and I think they got that one right. I mean, they thought inflation would be falling and the stock market would be rising, and that is exactly what happened. A couple other things they did predict were likely to happen is the electric vehicle revolution would stall out a little bit, some other trends. They got a few things wrong. We heard people saying they thought the Ukraine war would end last year. And we had some, of course, saying we were going to have a recession last year. They were basically saying what a lot of economists were saying, and they all turned out to be wrong. No recession in 2023.
All right, well, we'll see how these predictions for this coming year turn out. Appreciate it, Rick.
Bye, guys.
It has been a tumultuous year for retailers as inflation and higher rates fluctuate consumer behavior. Yet resilience in consumer spending did peak through amid economic headwinds, revealing bright spots that can shape the wider consumer landscape in the coming year. Here to discuss the retail trends to watch, we have RJ Hottovy, Placer AI Head of Analytical Research. It's good to see you, RJ, especially with a different hat than when we used to talk to you. So appreciate you joining us. So it's interesting when we look at the retail trends that you're expecting in the coming year. And I found a lot of them have to do with people not just spending on stuff still, but spending around doing things. Even if they're buying stuff, it's sort of experience related.
Yeah, there really is this kind of experiential or almost fear of missing out element when people are looking to spend right now. We saw experiences were one of the key categories of growth last year. And if you look at things like the Taylor Swift concert or Beyonce, or even Barbenheimer, the movie phenomenon, the halo effect that had on other retailers was absolutely phenomenal. So I think that's been a big trend. People are looking to spend. We see it in the restaurant category. We see it with players like Kura Sushi, the revolving sushi bar, or Gen Korean barbecue, where you actually cook at the table. People are looking to actually do different things when they dine out or have experiences. And retailers and restaurants are starting to figure this out. I mean, McDonald's has done a lot of promotions of celebrities. Other players are starting to get in this game too as well. So very much an experiential, very much a community experience kind of aspect to what we're seeing in the experiences right now.
And RJ, I just want to double click on restaurants for a second, because you know that category as well as anybody. Yeah. One interesting theme to call out that you called out, RJ, was dining concepts focused on serving suburbia will see growth in 2024. Yeah. How come, RJ? What's the theme there you're playing?
Yeah, it's a migration play, and I don't think it's gotten full appreciation by the market. This big massive shift we've seen away from urban markets to suburban and even rural locations has dramatically changed the real estate strategy for a lot of retailers out there. Instead of focusing on urban markets where you can go after workers, and we've seen some improvement in return to work this year, but we have seen it's almost stalled out, and a lot of people still continue to work from home. And so I think that this movement, players like Cava and Chipotle have really prioritized more suburban locations, and I think that's going to continue to play out. The other aspect of this all too is that the market that you built a location on 4 or 5 years ago has changed no matter what market you're in. Maybe it is that suburban to urban to suburban movement, but also we've seen a lot of movement to southeast markets, Dallas, Houston, Florida, Tampa, Orlando, Key, Carolinas. All these markets have seen a lot of growth, and not just population growth. In many markets, we've seen a lot of higher household income market population growth as well. So I think that these markets are going to be ripe for expansion. A lot of restaurant and retail growth in these markets, but also probably M&A activity. We saw Aldi acquire Winn-Dixie in the Southeast. That's not going to be the last deal that capitalizes on that migration pattern.
And another sort of related trend to what you're talking about is a term I wasn't familiar with, but I'm certainly familiar with the phenomenon, placemaking. In other words, sort of these planned developments, if you will, that are mixed use that almost create sort of town squares in some cases. We've seen that trend over the past couple of years. Do you think we're going to see an acceleration or just sort of a thriving of the ones that already exist? How's that going to pan out?
I think we're going to see an acceleration. I mean, I think at this point now that a lot of the commercial real estate properties that you pointed out that had adopted a mixed-use strategy, whether it's a community square, apartment buildings, or other ways to better engage with those consumers, we're seeing some real positive results. If you look at those properties that have implemented those kind of features, we see a lot higher visit frequency. We see the trade area that they pull from being a lot wider. And we see it continuing too. It's not like this is just a one-time effect. We're seeing some real positive results. So I think a lot of commercial real estate properties are going to continue this trend and change the way they go about not only building a particular property, maybe they're going to renovate it too and have more of these community aspects to it too, but also changes who you pick in terms of tenants for these locations as well. But what's interesting too is it also starting to change at the tenant level. Higher interest rates right now, people are looking to maximize the return on their physical assets. And so you're seeing things like, maybe we'll add a car wash to a gas station location, maybe a pickup window at a full service restaurant. Maybe it's, some of these larger retailers that are looking at retail media. Hey, maybe we can get some advertising revenue from our physical store spaces as well. So it's really changing the way things about it. So placemaking is really taking place at both commercial real estate and retail. Some really interesting things taking place there.
And RJ, also get your take on the grocery industry in 2024 as well. We're waiting to see how Kroger, Albertsons, how that merger, plays out. But what do you see for that industry in 2024? Do you see more consolidation, RJ?
I do. I think we're going to see more M&A activity. I think a lot of it driven by migration and where people have moved to. But I also think there's just other industry trends. I mean, if you look at grocery this year, value was really the number one trend. But it's not just low prices. I think that's oversimplifying it. I think it really came down to innovation at the value price. And so those that are doing new things at the bottom price, new SKUs, new flavor profiles. Trader Joe's is a perfect example of this, where people are looking at what new products are on the shelves every month. So I think we're going to see more and more of that, M&A activity there too. But very much still focused on value. I think it is the players like Grocery Outlet and Aldi's and the dollar stores to some extent too that are really capitalizing on this movement. But again, it's not just having the low prices. I think right now it really is about creating excitement at that value price point.
Speaking of value and sort of adding on sustainability, one of the other trends you see is continued secondhand apparel demand, or I guess not just apparel demand. And this is interesting to me because while anecdotally it feels like that's caught hold, if you look at some of the publicly traded companies that play in that space, they haven't all done that great. So how do you think that is going to evolve over the coming year?
I think the demand is there. I think we're certainly seeing it, particularly among that younger, consumer who's just starting out the professional career. They still want to kind of stand out. There's still this individualistic aspect to it, and that was one of the actual trends we started to see later in the year. Some of the apparel retailers that kind of focus on more individualistic styles really did pretty well compared to the rest of the category, despite having some discretionary spending headwinds. So I think that we're going to continue to see this demand for secondhand. I think as a category, I think there's still some infrastructure that needs to be built out, some things that, from a professionalism standpoint, just kind of that industry needs to mature a bit more. But I think there still is a demand. So I think that's going to continue to play out in 2024. And again, it plays in this idea of value, but not just low prices, something unique that I'm not getting somewhere else. And I think secondhand really fulfills a lot of that.
RJ, it's always good to see you. Thank you for joining us today and for those insights.
Thank you. Thanks for having me.
And kind of online ordering and delivery platform Drizzly prepping for a big New Year's Eve. We'll speak to their head of consumer insight to discuss the holiday season and the latest trends in the beverage industry. Stick around, more Yahoo Finance on the other side.
As we inch closer to New Year's Eve, you may be checking your liquor cabinets to stock up for parties, but a big trend in the refreshment sector this year has been the growth of non-alcoholic beverages. Online ordering and delivery platform Drizzly seeing the share of non-alcoholic beverages growing 62% since last year. For more on this and much more about what's going on in the space, we turn to Liz Paquette, head of consumer insights at Drizzly. Liz, it's good to see you. I do want to dig into the non-alcoholic, but first I just want to kind of ask you big picture. What has surprised you the most this year? I know non-alcoholic has seen a big change. What are the trends that have sort of stood out the most, surprised you the most as you reflect on the year?
Sure, and thank you so much for having me. So in terms of what has surprised me most this year, non-alc has definitely been one of those that has moved from being an upcoming trend to a trend that is here to stay. This is something that consumers are going to continue to look to when they're hosting, celebrating, having everyday kind of occasions with friends and family. So last year, non-alc sales were up about 34%. They're up about 62% this year. And what's driving that in large part, which is interesting, is that non-alc beer is actually the #1 subcategory within the non-alc category specifically. However, we're seeing spirits accelerate quite a bit this year with sales in that category up 162%. So finding that consumers are looking to make more mocktails at home, which is in large part a trend that is in line with overall consumption within the bev alc category as well. Consumers continue to mix cocktails at home kind of post-pandemic as they created this new behavior.
And Liz, I'm interested for consumers, on your platform right now. How are they spending, Liz? Are they spending up for the more expensive drinks or kind of downshifting to less expensive drinks?
Yeah, so absolutely value is a bigger indicator for consumers this year and something that's critically important for purchase. We're seeing delivery of the bev alc category continuing to be strong in this year. However, consumers are citing value for their money as one of the main indicators of something that's important to them when purchasing. And then we're seeing that reflected in average unit prices as well. So in the spirits category specifically, while this is our number one top selling category on the platform, and we actually saw some growth in this category year over year, we are seeing the average unit price decreasing actually year over year by about 3%. And we're finding two shifts within the price points that consumers are purchasing within that as well. So while in years prior, it was in last year specifically, it was 40 plus that we had more sales or a higher percentage of sales in this category. We're seeing consumers trade down a little bit more in the spirits category specifically this year. And interestingly, though, in wine, we're seeing folks are actually continuing to trade up a little bit more in this category when compared to spirits. So average unit price is pretty flat year over year in wine specifically, and we're seeing consumers purchase at a higher price point overall.
I want to zero in on beer specifically because beer, 2023 was not good for beer, both sort of on a big public relations front, but also on people actually buying beer, which didn't do much. And on your platform, share beer sales flat here. Is anything going to change next year? And if so, what is going to make it change?
Yeah, so on paper, this doesn't look like a great story, but I actually see this as a little bit of a potential turnaround on the horizon for beer. So we've seen declines actually within this category over this past couple of years in particular. And this year, seeing beer be largely flat actually indicates potential for growth in the future from my perspective. When you look at core beer on our category, so that excludes hard alternatives like hard seltzers, hard lemonades, which are grouped within that beer category, we're seeing it actually up slightly year over year. And in the last 3 months in particular, core beer has seen even more of an increase when we look year over year. And then specifically light lager, which saw some significant declines from a share perspective as hard seltzer had that big trajectory over the last few years. We're seeing that now increase. So we're anticipating that actually this coming year might be the start of a slight comeback for beer in the coming years.
And as we head into the new year here, Liz, what's most popular? Is it all champagne right now?
It's not all champagne, although we do anticipate that champagne will continue to be the top seller for New Year's Eve this year. When looking at December sales this year compared to last year, we have seen slight declines in champagne year over year. It was knocked out of the number 4 spot on the platform by vodka. So cocktails are also a big go-to for this holiday. It's a huge hosting occasion. People are gathering, mixing up different beverages for their guests. And with spirits being, of course, the number 1 seller on the platform, we'll see that actually continue to be the case here for this holiday as well. So we'll anticipate champagne to be number 1. We'll anticipate vodka and actually reposado tequila to be big sellers for this holiday. Liqueurs, cordials, as people look to make those cocktails at home, we anticipate those will be top sellers as well. And then this is a trend that actually began last year, but we're also seeing that continue this year, that Prosecco has continued to increase in share pretty significantly year over year as well. And we anticipate that while it won't necessarily kick champagne out of that top spot, it will be sparkling that folks are reaching to en masse for this New Year's Eve occasion.
And Liz, finally, just want to circle around back to where we started, which is in the non-alc category. Again, sort of anecdotally, I've definitely noticed an expansion in the number of offerings within that category. What do you think we're going to see on that front in the coming year here? You know, just the accessibility and the what's out there that's available for people.
Yeah, absolutely. And this is one of the things that is, of course, driving the growth in the category, right? Beyond the wellness trends, consumers' general awareness of the category and normalization of the sober curiosity movement. The fact that there's so much innovation in this space is going to continue to contribute to that growth. What's really interesting is ready-to-drink cocktails continue to be one of the top sellers on the platform and one of the fastest growing on the platform. And we actually see RTDs growing in the non-alc space specifically as well. So not only are you seeing more traditional beer, wine and spirits in the non-alc space, but you're also seeing cocktails come into play now. Lots of mixers, bitters, cordials kind of getting into the mix with these spirits. So I think you'll just continue to see growth across the board and anticipate that spirits are going to be the category that we see that the most in this coming year.
All right, we'll be watching. Liz, thank you so much for joining us today. Appreciate it.
Thank you. Thank you for having me. Happy New Year.
You too. Coming up, we're recapping the biggest box office hits from 2023. Stay tuned.
Since the dawn of time, humans have experimented with technology. From the failed banana phone to the more impractical but still successful string telephone, to the beacon, the idol, the holy grail, the smartphone. It's beautiful. It's majestic. It's Yahoo Finance at CES 2024.
As we count down the days to the new year, we wanted to chat some of the biggest box office hits from the past year. And one surprising fact for this year, for the first time in more than 2 decades, the top 3 movies did not include one sequel or remake here. If you look at data that was compiled by Associated Press here, the 3 top movies, Barbie, the Super Mario Brothers movie, and Oppenheimer, none of them were sequels, and none of them, strictly speaking, were superhero movies. So I've seen a couple of think pieces recently on whether the age of the superhero at the cinema is over, and that's because we saw some big Marvel flops this year, not to mention the new Aquaman that just did not do well at the box office, right? So all of that may be pointing to a shift in where Hollywood is going to be putting its money.
Yeah. So, I mean, when you look at the sort of the superhero movie category, I guess what people are still saying, listen, some of these movies still rake in a ton of money. I mean, you look at like Sony's Spider-Man Across the Spider-Verse, $691 million, right? Disney's Guardians of the Galaxy Volume 3, Julie, I don't know if you saw that one.
I saw that one in the
Did
theater.
you really?
Yeah.
Did you like it? Because a lot of people, listen, 846 million.
But it didn't get, it got mixed reviews. I thought it was pretty good. I thought The Marvels was pretty good. I saw that in the theater as well, but that one also disappointed vis-a-vis expectations.
So even though, but to your point, I get some people are saying they look at kind of the superhero movie category and they do wonder, in their words, whether there's some sort of like chinks in the armor there because of the reason you brought up, that for the first time in more than 20 years, what were the top 3 movies at the box office? It didn't include one sequel or remake. It was Barbie, Super Mario Brothers, Oppenheimer.
Which you saw.
Which I thought was great. I mean, I know it got kind of banged up because it was 3 hours, but I thought it was phenomenal here, actually.
So favorite movie of the year, was that Oppenheimer?
No. Favorite I'm going to give to John Wick Chapter 4.
Are you being serious?
Totally serious. Oh, obviously. John Wick, come on, armed to the teeth, vengeance against the high table. You're not into it? No? Can't
I
say
haven't seen any John Wick movies.
Okay, that's...
And you haven't seen any Marvel movies.
Why do you hate America is my next question, I guess, because that's outrageous.
Action movies aren't really my thing. I like the superhero action movies, but I don't like just like pure action movies. I haven't seen any of the Fast and Furious movies.
All right, so what have you seen? What was your top?
What
was your top? What got the gold in the Julie Hyman household?
I guess Barbie, but that's
really?
Just because, like, what else would I choose? I don't know.
I tried,
Like, I didn't see a lot of movies in the theater. I saw Super Mario Brothers. Fine. The kids liked it. Jack Black's voice was amusing. I didn't see Oppenheimer. I did see The Marvels. I did see Guardians of the Galaxy Volume 3. Both of them, like, they weren't, it ain't high art, you know what I mean? Like, it's an entertaining
It's high
2
entertainment.
hours.
It's high entertainment. Barbie, I did try. I took the 4-year-old, but it was we made it like 20 minutes.
No, that was not.
No, that was poor planning on my part.
I liked very much the Ken's dance sequence in the Barbie movie. That might have been my favorite movement. I liked the feminist message. I found it a little bit like conk you over the head at times, like a little too obvious, but I appreciate the sentiment.
The sets and the messaging and the dancing.
Yeah.
That's what sold it. All right.
Yeah.
Fair enough.
That's a lot to be said for all of that. All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
People can say what they want, but we just keep doing the work. You just keep repeating and envisioning that and helping the team to see that, you can get through almost anything.
Beyond Meat and its CEO Ethan Brown burst onto the scene with a sizzling IPO at the Nasdaq on May 2nd, 2019. The company's market valuation quickly surpassed $14 billion, as seemingly everyone was excited about the future of plant-based meat. There were deals with Target, Dunkin' Donuts, you name it, everyone wanted a piece of Beyond Meat.
Every reason that we started this company and every reason that the consumers are reaching for our products strengthens every single day. It's hard not to be passionate about it because you can help so many people. We know that people love animal protein, right? And so if we can create that directly from plants in a way that eliminates the animal, get the taste exactly right, make sure that people understand the health benefits. And the third is get the price to the point where it is at parity or below that of animal protein. This transition will occur and it'll start to occur more quickly.
Brown's vision was dealt a serious setback during the COVID-19 pandemic. As a result, Beyond Meat's stock price took a big hit.
We expected there to be pushback, but just seeing it happen and being on the receiving end of it has been eye-opening.
But despite everything that has gone on with the company, how have you stayed centered?
I appreciate that question. One, I have a great core team of people around me. We're trying to do something that is not going to happen overnight, that has fits and starts. We're going to make this thing into the long-term success that we've been after. I would be dishonest if I said it hasn't been difficult. There have been challenges, but there's been more reward than there have been challenges. There's been more opportunity to impact change than not. And if you look at this from a historical perspective, you should expect this.
Why is it so hard to change consumer mindsets?
I think this is something that, unlike, let's say, shifting from the fax machine to digital communication to the landline to the mobile phone, we're not trying to change something that has just been around for a couple hundred years. Now, the way to think about it in my mind, though, is to not change it, is to simply change the material, right? So provide the consumer with that delicious whole muscle steak, provide the consumer with a burger, provide the consumer with sausage, and it's just a different source of the protein. That's it.
How have you dealt with some of those challenges from your perspective as a leader, not just as a CEO, as the founder?
I think it gets back to who you surround yourself with, and whether it's my team here or my board. My board has been incredibly supportive of this effort. They're seasoned enough to have a long-term view. I think the other piece is, organizationally, I've gotten to really embrace the horizontal flow of value through an organization. If you think about the way we've set up businesses, and we think of organizations in general, it's always vertical. We've got the sales, marketing, operations, finance team, et cetera. But that's not the way value flows. Value flows from product ideation all the way through to the consumer. So it's really horizontal. And so from a leadership perspective, it's really how do you teach people to think about the team as one single team and not as a department. This is really the lean style of management, and it's the lean management principles, and that is really the right way to run a business.
In 2021, Beyond Meat opened a sprawling 288,000 square foot headquarters in a former aircraft hangar in El Segundo, California. The location is outfitted with a state-of-the-art test kitchen that may foster the next big thing in plant-based food.
Ethan, this stuff looks really good. I watched it being cooked. It grills like steak.
I love this product, and it really starts with what we were talking about earlier about at the farmer level. So this is made from fava beans, which are being grown in North Dakota. Fava beans fix nitrogen back into the soil. So the farmer's able to use less fertilizer, which means they're able to make more money with each acre, right? So there's no animal in this entire process.
Is your mindset still, and I think we talked about this in the past, to fail fast and fail often?
Absolutely. So our program, our innovation program, the Beyond Meat Rapid and Relentless Innovation Program, that's at the center of it, is that we're going to move more quickly than anybody else, and we're going to fail and recover more quickly, right? And I think one of the challenges that particularly young people have is they're being dealt perhaps their first failure, right? And so many of the people that work here are coming out of really great academic backgrounds. And so it takes them a moment to realize that, not delivering on something is not the end of the world, as long as they get back up and fix, right? And so we have to figure out how to get people comfortable with quick iteration, quick failure, and then quick recovery. And so it's a big part of our culture.
So Ethan, as someone dealing with these big leadership challenges, tell us about your style. How do you rally the troops, and how do you get out the message that you're trying to change a category that is well established? It's meat. You're going up against big meat.
Yeah, we talk about this every day. I mean, first and foremost is the true north. And that's what most leaders will have the team focus on. And so if we stay true to that true north, which in our case is to provide a plant-based meat that is indistinguishable from animal protein, do that at a price that everyone can pay. You just keep repeating and envisioning that and helping the team to see that. You can get through almost anything.
So Ethan, you see this upstart industry, lab-grown meat. It's out there. It's taking form. As a founder and a leader who have a company that does it differently, does that change how you lead Beyond Meat?
The moment you walk in this building, you should feel a sense of urgency. Whether or not it's in vitro meat or some other technology, you're always going to be acting with a sense of urgency. In fact, I
wanted to ask you about that. What it says somewhere, someone is working harder on your idea than you are. Does that still power you today?
It just summed it up for me. Because whether you're an athlete or a professional, there's always somebody that's working really hard. And so you just have that competitive mindset that if it doesn't motivate you enough to just bring this goodness to the world, competition can also motivate you.
Is it tough to turn it off?
Yeah. When your work is your mission, it's almost impossible.